Is the Federal Reserve actually trying to cause a stock market crash? It is insanity to raise interest rates when stocks are already crashing, but the Federal Reserve did this anyway. That's not to be done, because otherwise there's going to be an economic problem, obviously. Michael Schneider, economic collapse. This is on the Millennium Report. The Federal Reserve has decided not to come to the rescue this time. All of the economic numbers tell us that the economy is slowing down, and on Wednesday, Fed Chairman Jerome Powell even admitted that economic conditions are softening. However, the Federal Reserve raised interest rates anyway. As one top economist put it, raising rates as we head into an economic downturn is economic malpractice, quote unquote. They know that higher rates will slow down the economy even more, but it is not as if the Federal Reserve was divided on this move. In fact, it was a unanimous vote to raise rates. They clearly have an agenda, and that agenda is definitely not about helping the American people. Early on Wednesday, Wall Street seemed to believe that the Federal Reserve would do the right thing, and the Dow was up nearly 400 points, but then the announcement came and the market began sinking dramatically. The Dow Jones Industrial Average lost 720 points in 2 hours, and the Dow ended the day at a total down of 351 points. This is the lowest that the Dow has been all year. 60% of the stocks listed on the S&P 500 are in bear market territory. At this point, approximately $4 trillion of stock market wealth has been wiped off. $4 trillion. We haven't seen anything like this since the last financial crisis. This is officially the worst quarter for the stock market since the fourth quarter of 2008, and it's the worst December that Wall Street has experienced since 1931. And this is all because of what the Fed did. It's insanity to raise rates, the interest rates when stocks are already crashing, but the Federal Reserve did this anyway. They knew what kind of reaction this would cause on Wall Street and in other global markets, but this did not stop them. The financial world is in utter turmoil, and this move by the Fed has definitely added fuel to the fire. Could it be possible that they actually want a stock market crash? Some are suggesting that the reason why the vote was unanimous was because they wanted to send a strong signal, quote unquote, to President Trump. He has been extremely critical of the Federal Reserve in recent weeks, and this could be a way for the Fed to show Trump who is really in charge. So what is this, a type of a vendetta, and they're taking it out on the American economy and the whole global economy? They're calling this the Trump economy, quote unquote, but that is simply not true. And when Barack Obama was in the White House, it wasn't, quote, the Obama economy either, end quote. Ultimately, it's the Federal Reserve that is running the economy, and they fiercely guard their independence and their authority. President Trump knows that the only way that he's going to win in 2020 is if the economy is doing well, and he also understands that higher interest rates will slow the economy down. So essentially, the Federal Reserve has a tremendous amount of political power in their hands. During the Obama era, the Fed pushed interest rates all the way to the floor and kept them there for many years. But now the Federal Reserve has raised interest rates 7 times since Donald Trump took office, and 4 of those rate hikes have been under current Fed Chairman Jerome Powell. Needless to say, it certainly doesn't take a lot of imagination to figure out how Donald Trump is feeling about Powell at this moment. GreekFire23 tweets, "For some reason I keep envisioning Trump walking into this presser saying, 'Jay, you're fired. I'm sorry, you're fired.' Then going to the podium and saying, 'Jay is a great person. He has a beautiful wife, very smart man, but I will find someone who is going to do a great job.'" Meanwhile, we continue to get more indications that the U.S. economy is heading for difficult times. Just consider the following news about FedEx. FedEx shares are plunging after what Morgan Stanley called a jarring cut to its annual forecast, suggesting global growth is slowing far more than most expected. In fact, the bank hinted at the possibility of a severe recession unfolding and prompting expectations of an uber-dovish hike by the Fed. The global logistics bellwether slashed its outlook just 3 months after raising the view, reflecting an unexpected and abrupt change in the company's view of the global economy amid rising trade tensions between the U.S. and China. Not only were the cuts were deeper than the street expected, according to Morgan Stanley analyst Ravi Shankar, but everyone is pointing to the following comments from the press release. Quote, global trade has slowed in recent months, and leading indicators point to ongoing deceleration in global trade near term, end quote. To see the term severe recession used in such a context is more than just a little bit alarming. Severe recession? The last time the U.S. economy went through a recession, millions of Americans lost their jobs, and we saw a wave of mortgage defaults unlike anything we had ever seen before in modern American history. We're about to go through something similar again. Earlier today, a CNN article also used the term recession, and it discussed the fact that investors now want big corporations to focus on paying down their debts instead of buying back shares of stock. Fears of an economic slowdown or even recession have turned a spotlight on the debt that businesses piled up during the past decade when borrowing costs were historically low. For the first time since the Great Recession, investors want companies to prioritize paying down debt rather than investing in the future or share buybacks and dividends, according to the Bank of America Merrill Lynch survey of global fund managers. But stock buybacks are one of the only things that has been propping up to the stock market. The only way for the bubble to continue is for corporations to go into dizzying amounts of debt in order to fund massive stock buybacks, because the Federal Reserve clearly does not intend to support the markets right now. At least for the short term, the Federal Reserve could have calmed markets and encouraged economic activity by leaving interest rates alone. In the end, they decided not to do that, and that makes one wonder what they are really trying to achieve. This is from the Economic Collapse blog, and it's on the Millennium Report. If you'd like to join me on my Patreon account, you will hear content not covered by mainstream media. These riveting stories will be based on my research, and I will state my opinions and give my personal insight on diverse and controversial subjects and world events not covered by mainstream media, and not supported by YouTube guidelines. So whatever I have on my Patreon, most of those will not be on my YouTube channel. Please consider becoming a member today. More of the most significant and important videos will be on my Patreon channel. Your support helps me to continue my research and keeps this YouTube channel alive. And we depend on your support, your generous charity, because we help economically challenged families here in Athens, Greece, in Kapota, and we also help the young generation with university tuition and the community around our church. Thank you.